assistant with the program. Some housekeeping items for the webinar today. There will be opportunities to ask questions throughout the webinar. If you have questions, please enter them in the chat box and we will repeat them for the speakers. Established in 1998, our flexible hybrid program tailored to individuals working full-time in all areas of food, agriculture, and animal health has reached more than 500 students. We were the first distance degree program in the country focused on the business and economics involved in managing production agriculture, food, and animal health companies. Not an MBA and not an MS in agricultural economics, we are a professional degree program aimed at training managers for peak performance in one of the most rapidly changing industries today. Our students come to us with a bachelor's degree, 2 years of professional experiences, and having completed some prerequisite coursework. The companies and agencies who employ our students indicate that the skills our graduates hone while in the program directly impact their teams, divisions, and companies in a positive way. With us today is Dr. Brian Coffey. Dr. Brian Coffey is an associate professor in the Department of Agricultural Economics at Kansas State University. He teaches undergraduate courses in production economics and futures markets. His research is focused on the scholarship of teaching and learning, consumer demand analysis, and livestock economics. Before joining K-State, he taught for several years in Central Asia and consulted for a variety of small, private agribusinesses in the region. He holds a bachelor's and master's degree in ag economics from the University of Kentucky and a doctorate in ag econ from K-State. So with that, I will go ahead and turn it over to Dr. Coffey.
All right, thanks, Jody. So good to be here. Thanks everybody for joining. Let me see if I can get you my PowerPoint presentation. Hopefully you're seeing that now. The purpose of our time today is to give a quick introduction to futures markets and how that producers or people who need to purchase commodities can use futures markets for hedging. So it'll be kind of a fast overview of that, and I hope it's helpful. My goal is to get through this kind of view of futures markets and then get through a couple of specific examples and leave a few minutes at the end for questions. So as you have questions, think about what those are and happy to field any of those. And so with that, let's get started. So futures markets, what in the world's going on there? So futures markets are markets where we have specific contracts for an underlying physical commodity, and those are very carefully defined by amount of the commodity, quality of the commodity, all sorts of things. And then they're also connected to a time. So they expire at a certain time. So for example, you might hear people talk about December corn futures. So December 2021 corn futures means that in the last trading day of December, that corn contract will expire. All right, so we've got these well-defined contracts. If you enter into these, you are entering into a legal obligation. All right, and you can do that in one of two ways. You can be obligated to provide or deliver the commodity that exactly matches all those specifications in the contract, or you can be on the other side. You can be obligated to accept that delivery. Again, accepting exactly what's specified in the futures contract. Now, if you have committed to delivering, then that means you're short one futures contract, right? You have this obligation coming up that you have to make good on. So we call that being short. We also use the jargon sell. So if you've entered into this side of the contract, we say you've sold a contract. I always like to explain here that sell is jargon. And this is, I think it throws a lot of people off. You haven't actually sold anything, right? You've entered into a legal agreement that says you will provide this, but it has kind of the same impact as if you had sold. So we use the sell jargon. If you're on the other side of that, then you've agreed to accept that commodity, and we call that buying. Again, you haven't really bought anything yet. You've entered into a legal agreement that says, at this specific point in time, I'll accept this well-defined amount, quality of commodity. All right, so those are your two options there. You can either be obligated to deliver or obligated to accept delivery. Now, once you're in the contract, you basically have two options, and there's some subtleties here and nuance that we won't get into. We can dig into some of this in questions if you want to, but the one way you can get out of that contract is allow it to be settled. If it's a deliverable contract, then that means either actually receiving the delivery of the real commodity or going out and delivering that commodity. And the contract specifies all of that, the procedures for that. And sometimes it can be quite complicated, but that option's out there. And so you would make good on your contract that way. What is much more common is that you can offset your obligation by simply going out and doing the opposite in the futures market. So for example, if I have bought a March corn contract, so I'm long March corn, then I go out in the March corn futures market and I take the opposite position, right? I sell a contract or I take a short position. Well, I've agreed to accept delivery and now I've agreed to deliver. Those two things cancel out. I'm out of the futures market. But either way, you have to somehow get out of your contract. Those are the two big ways. Now, anybody who enters into a contract, whether you're on the short side or the long side, someone else is on the other side of that contract. So for every long, we have a short. For every buyer, we have a seller. And sometimes I think in explaining, price movements, people might get this a little bit wrong and say, well, prices are going up because in the futures market, because we have more buyers than sellers, or prices going down because we have more sellers than buyers. That's not possible. That's not the way these markets work, right? They're offsetting. If prices are going up, it means the people who are taking those long positions, the people who are buying are more aggressive. But for every long, there has to be a short. For every short, there has to be a long. And then as we go down to contract expiration, every contract must be either settled or offset, all right? And so all of this adds up to the fact that futures markets are a zero-sum game. And so if you read almost any futures markets textbook that explains what's going on, you'll see this zero-sum game phrase thrown out. It just means if I make $1 in the futures, in the March corn futures contract, somebody else had to lose $1, right? Everything offsets. It's a zero-sum game. Okay. Now, how do we get this idea of futures markets being tied to cash markets? And this is extremely important to understand in terms of hedging. So what a futures market does is it allows people all over the world to bet on what's going on between a futures price and the price of the underlying cash commodity, right? So we've got again, I keep throwing out corn as an example. We could use any other commodity, but we've got a corn futures contract for December. So we're saying, what do we think that corn price is going to be in December in the futures contract? And then we've also got related but separate actual physical corn that we can buy and sell in the cash market, right? So people can watch both these markets and they can basically bet on what's happening. And what they're doing is looking, a lot of times is looking for arbitrage opportunity. And what we say is if these markets are efficient, all this trading activity comes together and it helps us land on a price for corn. All right. You can decide if the price is right or not, but the market will land on a price, and that's what we call price discovery. Now, why would cash and futures track each other. That's this idea of arbitrage. And arbitrage is just an economic word that means I can do one activity in one market and the opposite in another and automatically make risk-free money. Okay, so I've got this opportunity. I can buy low in one market, sell high in another, and make money. All right, so this is how we tie the futures and cash together. So let's again look at corn, and let's say that we've got a local cash market and corn is selling for $4.50 a bushel. I obviously didn't update this given recent events, but work with me, $4.50 a bushel for local cash corn. And let's say we're going down to March, and that March futures corn contract is going to expire soon, and it's trading for $5 a bushel. Well, what could I do? I could go out in the March futures and I could deliver corn, right? I could enter into a short contract or sell. Then I could go to local cash market. I could buy enough corn to exactly match that contract obligation and then deliver on it, right? So I buy my real physical corn for $4.50. I go out and I say, hey, I've got this contract that says I can sell corn for $5 a bushel. I do that and I get a return of 50 cents a bushel. Now, doing that isn't free. So if you want to think in terms of profit, it would be that 50 cents a bushel less whatever transaction cost it took you to do that. But if that leaves you profit, that's arbitrage. Okay. Now, if I see that opportunity and I go out and do that opportunity, take advantage of that opportunity, what else is going to happen? Well, like I tell my classes, there's a lot of people in the world with money who are smart, who want to make more money. Right? So if somebody sees me do that and this opportunity is out there, I'm not the only one that's going to know that, right? So other people are going to go do the same thing. As they buy in this local cash market, buying pressure will raise local cash prices, right? And at the same time, as they go out and sell that March corn futures contract, the selling pressure will bring that price down. And where will they stop? Well, they'll stop when there's no arbitrage opportunity. So they should stop when the difference between the prices is just about the equal to that transaction cost, right? So now there's no more incentive to go out and take all the trouble to do that, right? And so this is how we link cash and futures prices. And this is why we have some confidence that going down to contract expiration, these prices are going to converge. Now, whatever's left, the difference between the cash and futures, we call that basis, right? And so this basis we'll get back to, we'll talk about it later, but notice here, there's no reason that cash and futures have to exactly equal each other. The difference between those should roughly reflect the cost that it would take to go out and actually do what I've described here. Now, we could set this example up exactly the opposite and have local cash price be higher than futures, and then you would just do the opposite, right? You'd buy corn out of the futures market and sell it back on the local cash market. And again, this is a kind of a complicated thing to do in the real world, but the opportunity's there. And for commodities that are not deliverable, the same point is there. It's just that instead of actually delivering the physical commodity, you settle against a financial index, and the process is exactly the same. So with that, we've got futures and cash moving together, hopefully, and the difference between the two going down to expiration is called basis. And we define that usually as cash minus futures. And so in grain markets, we expect that number to be negative. It isn't always, but we expect it to be negative because grain in the future, right? The difference between grain right now and grain in the future is that grain in the future has to be stored and taken care of. So you have to be paid for storage, for carrying the grain. So generally we think about futures as being above cash in the grains, in storables. In livestock, which are semi-storable or non-storable, it's not as straightforward. It can be positive or negative basis, but that's the idea. And what does basis tell us? Well, basis basically is the market telling us where it wants its product. So a strong basis, if you see this jargon of strong basis, it just means cash is high relative to futures. And that is the market saying, we want this commodity in this area, right? Now, weak basis is the opposite. Cash is lower relative to futures. That's the market saying, we don't need any more of that stuff in this area, right? So you look at a basis map, you see where the stronger basis is. That's the market telling you this is where we need the product. All right. So the next thing that we talk about in futures markets, so we said there's price discovery going on. There's also the function of transfer of risk. And this leads us up to the hedging. All right. So futures markets have two types of traders. There are hedgers. And the thing that makes a hedger is that their business somehow depends on the underlying physical commodity. They might need to buy that commodity. They might need to sell it. They might plan to buy it and then process it into something else. Whatever's going on, their financial livelihood depends on that underlying physical commodity. And they want to go out and they want to use the futures market to mitigate the price risk of that commodity, whether it's an input or an output. On the other side is the speculators, right? And the thing that makes a speculator is they need not have any connection to the physical commodity. And what they're wanting to do is they're actually wanting the opposite. They say, okay, we know there's price risk in the futures market. We know prices move around. I'm going to take my knowledge and try to bet on that and leverage my knowledge to make money. Right. So just like all of us do this in different parts of life, not all of us do it in the futures market, but we're saying I'm willing to expose myself to some risk for the chance of making some money. Right. So these two groups are out there. Now, quick note here, we need speculators in the market. There's not going to be enough hedgers to make a futures contract liquid. So whatever else we might talk about later or might be written or said about speculators, we certainly need them in the market. All right, so we'll leave that at there. If you want to get more into that in the questions, we can try. And so a hedger is going to use that relationship that we just talked about to transfer price risk to somebody else. Okay, now a hedge is a risk management tool. It's not the only tool out there. It might not be for everybody, but when we talk about hedging today, I want to get that across that I'm talking about it as a completely a risk management tool, not income enhancement, not enhancing returns, but specifically managing or mitigating risk. And so a hedge from this perspective can do two things. It can help a producer or a processor, help a hedger, let's say it that way, avoid catastrophic losses. So a lot of times in economics and finance, we are guilty of thinking in terms of average returns over time. And we say, well, this is the average returns over several quarters or several years for this activity or that activity. And one thing that we forget is that in the real world, if a given quarter or a given year is bad enough that you have to go out of business, average return no longer matters, right? If you can't continue in business, then average return doesn't mean anything. So hedging allows a way to avoid these catastrophic losses in a given period. The other thing it does is establish a more predictable target price. And that could be useful for business planning. That could be useful for cash flow planning, could be useful for all kinds of things. But these are the two things that hedging can do, right? And so if you want to evaluate, is hedging for me? How much should I hedge, et cetera, these are always the two criteria to go back to, right? These are the only things you can accomplish with textbook risk management hedging. And so, how will these things help my business? All right. So a hedge involves having equal and opposite positions in the cash and futures market. All right. So equal meaning the amount of the commodity is exactly the same. Opposite meaning if I'm long in one market, I'm short in the other. And we'll walk through an example, hopefully to make that a little bit more clear. And a note here is the only time you're hedged is when this is true. So if you are offset, you have a cash position and a futures market position. And then if you're a seller and you sell your cash commodity, but you stay in the futures market, you're no longer hedging, right? Now you're speculating because you're not offset. So a hedge means you have the cash position, you have the futures position. And we'll say exactly how. What you're doing is you're trading price risk with basis risk. So you're no longer worried about how the level of cash price will move around. You're worried about how the difference between cash and futures will move around. So with that, let's go through 2 or 3 examples here. And I think this is, I kind of rushed through some of my definitions there. I think with definitions, people's eyes start to glaze over, and that I think going through an example is a little bit more instructive. So let's do that. So let's stick with corn. And so we've got a corn producer, and we'll say we're in April. All right. So we're in the month of April. This person is going to plant corn, and they are planning on harvesting about 40,000 bushel in October. All right. So that they're in the cash market, they are long corn, right? They're taking seed and fertilizer and herbicide and labor, and they're going to mix all that stuff up, and they've got corn coming their way, right? So they're long. Well, what do they need to do to be hedged? Like we said, they need to do the equal and opposite position in the futures market. So they're going to say, okay, I want to sell in October, my cash crop in October. So the December number 2 yellow corn futures matches the commodity and the time. Okay, now how many do I need? Well, one corn contract is 5,000 bushel. So I'm planning on selling 40,000 bushel of corn. I need 8 corn contracts. All right, so we're going to sell 8 corn contracts, take that short position in 8 corn contracts, and futures are currently trading at $5.50 a bushel. So now I'm obligated to provide or deliver corn at $5.50 a bushel, right? So I'm short futures. So notice if I go across my table here this way, I'm offset, right? Exactly with amount of corn and the position that I've taken long versus short, I'm offset. And if we think about basis, so current cash is 530 minus 550 futures, we're looking at a negative 20-cent basis. All right, so now we're planting in the cash market, we're waiting for corn to grow in the cash market, and we are hedged in the futures market. Fast forward to October. All right, harvest, everything goes well. We plan for exactly 40,000 bushels of corn, and we harvested exactly 40,000 bushels of corn. All right, so obviously to make my little example simple here, this number could vary a little bit. Principle doesn't change. The math just changes a little bit. So the cash market in October says, okay, we'll pay you $5.80 a bushel for your corn. And I go out and I take advantage of that and I sell all 40,000 bushels of corn. All right. And then at the same time, so notice since planting, prices have gone up. And then in the futures market, price has also gone up, right? Because those track each other like we talked about. So let's see what happens in each market. So in the cash market, I was long, I had corn coming my way. It grew, I harvested it, and then I went out and sold it. So I took a short action in the corn market. So I had corn coming to me, I sold it, I'm completely offset in the cash market. And the market let me sell that for $5.80 a bushel. So now in the cash market, I'm out. Okay. What about futures? Well, let's go back here. And I entered into this short position, which we call selling at 550. So that means I'm obligated to sell corn at $5.50 a bushel. 8 contracts worth. October comes around, price has gone up, and I need to offset my position. So what do I have to do? I have to take the opposite position, take a long position or buy. Well, it doesn't matter which order you do it. If you buy high, like we did here, and then sell low, that's bad, right? So to get my change in the futures market, I take my selling price and subtract my buying price. And so I am losing 50 cents a bushel in the futures market, right? Because I had a short position, I agreed to sell at 550. Price went up to $6, so I had to buy at $6 to offset. I'm out of the futures market, but bad news is I lost 50 cents a bushel. Okay, so cash, futures, that's what's going on. Put those together, that means that I paid an effective price of, I received an effective price of $5.30. I got my cash for 580, paid my losses in the futures market. I'm left with $5.30 a bushel. Okay, so this is a good example for right now. You know, if you hedge and then prices are going up, you give up that upside volatility, right? Volatility can be in your favor, risk can be in your favor. So you give up that upside volatility and you land on this price of 530. Now, that doesn't sound all that good, but what if we had the same situation, except price went the other way? So back in April, everything's the same. All right. So cash prices at 530 in April. I go out, I put on my short hedge at 550, but something different happens, right? And the market by October says, well, we'll pay you $480 for your corn. Okay, so now prices have moved against me in the cash market, right? And I'm able to sell for $480. But what about futures market? Well, this time I said, hey, I'll sell at 550, right? I entered into those obligations. Price went down. So when I go out to offset my futures market position, I can enter into an agreement to buy corn at $5. So I sell at 550, buy at $5, sell minus buy leaves me with a gain of 50 cents a bushel. Okay, so notice this time, if I put those together, I still land on $5.30. So this time I gave up that negative volatility. I mitigated that negative price risk. My gain in the futures market offset that. All right. And you'll notice that both times I landed on the same price. And the reason for that is that basis didn't change. Okay. We'll talk about that more later. But the reason I landed on the same price both times is that even though price moved in a different way, I kept basis here at negative 20, right? So because basis didn't change, I landed on the same price both times. So what's happening here is if you're a short hedger, you have a position in the cash market. And if prices are going up, then the value of that cash asset, or if you're a producer, you're thinking about the asset that you're going to have at harvest. So the value of that asset's going up. Well, if the value of your cash asset's going up, the value of your futures market position must be declining. You're offset there, right? That's what you want. You want to offset the big swings so that you're just focused on the basis risk. And what does the futures market do? It allows the short hedger to transfer this price risk to the speculator. The speculator has no cash, right? They're just in the futures position. So in this case, the downward in the hedger's business, the downward movement in the futures market is offset by the upward movement in the cash market, and the speculator can take advantage of that, right? If they're the long speculator, futures price goes up, they're happy. The short hedger is happy just to give up the price risk. If things move the opposite way, like second example, and our short hedgers making money in the futures market, but seeing that value of that cash asset go down, then our long speculator is losing money. But again, this is what the speculator wanted, right? They wanted to place the bet, try to guess where price were going, and this time it didn't pay off. And same thing again, the short hedger gets what they wanted because they're offset, right? The loss in cash value can be offset by the futures investment. So the transfer of risk happens either way. It fits the risk profile of a hedger. It fits the risk profile of the speculator. That's what futures markets are there to help us do. All right. Now, I also mentioned target price. So how do we land on a target price? Well, if you're a short hedger or a long hedger, what you're thinking is you need to know what futures price will be. And then the big one is you need to know what basis is going to be. So the best way, or the simplest, I don't know about best, simplest way to predict what futures price will be is just to use the futures price at the time when you hedge. There's all kinds of complicated ways that you might project what futures price are going to be. And some of those, that's fine. But I think for normal people who are not going to spend a lot of time with this, using today's futures price makes sense. And then you need a way to predict what basis will be when you lift your hedge. And so lifting your hedge is just when you offset your cash and your futures commitments, like we showed in our little table. All kinds of ways to do this. A starting point would be from University Extension Services, where we publish regional or perhaps even county level basis charts. That's a starting point. The more specific you can get to your operation, the better. So the better records that you have, if there's something about your local area that makes your basis different than other places, you need to know that. And the only way you know that is to track bids, to track the cash market, and understand what's going on there. So the more specific you can get your basis prediction to your situation, the better. All right. So that's a matter of record keeping. It's a matter of talking to people about exactly what things to track and so on and so forth. But understanding basis is really where it's at. And so let's look at an example of how that works out. So here is our first example, our second example, right? We put our short hedge in at 550. Price went down to $5. So I gained 50 cents in the futures market, right? At the time of sale, cash price was at 480, futures price was at 5. So basis was at -20. Well, that's what I guessed, right? I guessed basis would be at -20. So go back to the formula. Current futures plus basis gives me a target price of 530. Cash price landed on 480. Futures price landed on 5, but basis was exactly what I thought it would be. So 480 cash sale plus my gain in the futures market lands on 530, right? And so you can run this math. You can make prices go up, prices go down, however much you want. If you get the basis prediction right, you hit your target price, right? That's what it comes down to. Now, if you get basis prediction wrong, let's look at that. So here, same situation, right? We're selling here at harvest for 480 a bushel, but look what happened in the futures market. Futures markets moved from 550 to 505. Well, I was guessing a basis of -20, but what happened, actual basis turns out to be -25 cents a bushel, right? So I missed my prediction. So target price was current futures and my expected basis. Target price again was 530, but notice here, this time I sold for 550. I bought back in the futures market at 505. So my gain was only 45 cents and my net price received was 525. Look at the difference between 530 and 525 is 5 cents. Why? Because my basis prediction was 5 cents off, right? So this is why we say we're subject to basis risk, not flat price risk, or not just price risk. Again, you can do these examples, make price go far, far down or far, far up. As long as you get basis prediction right, you get your target price. Okay, so that's how we're exchanging price risk for basis risk. We will not go through this one in quite as much detail, but I just want to point out that it doesn't matter from your position if you are selling a commodity or buying it for your business. There's still a way to offset the price risk. So let's think about a flour miller, right? And so we're in December and we say, okay, in July, we need to buy 50,000 bushels of wheat to process that into flour. All right. And so we are short in the cash market, right? We've got business plans and agreements that we have to make good on, and we need wheat to do that. So short in the cash market. So what do? Well, just the opposite in the futures, right? And so how do we pick a contract? Well, July is when I want to buy. So the July contract, what do I need? I need hard red winter wheat. So I'm going to use the Kansas City hard red winter wheat contract. How many contracts do I need to be completely offset? Well, one contract is 5,000 bushels. So 10 times 5,000 is 50,000 bushels of wheat. So if I buy 10 July Kansas City hard red winter wheat futures contracts, I'm exactly offset. Okay. And we'll say that the futures price is $5 a bushel there. So we're saying I will accept delivery of wheat at $5 a bushel. That's my legal obligation. And let's look and see what happens. So we fast forward to July. The cash market says we will sell you wheat at $5.25, $5.25 a bushel. So that's what I have to pay for it. I was short. I needed wheat to do what I wanted to do. And so I go out and buy it. Now I'm offset in the cash market. I'm ready to go. And it cost me $5.25 a bushel. What about futures markets? Well, I bought at $5.50. I said I will deliver at $5.50. At time of purchase, the futures contract is trading at $5.50. So I go out and take an offsetting position, say I'll sell, all right, at $5.50. So that gets me out of futures market, right? I promise to accept delivery, then I promise to deliver. Those two things offset. So we say sell at $5.50 minus buy at $5. I made 50 cents a bushel in the futures market. So price went up, which is bad for someone who needs to buy wheat, but I was offset in the futures market. So what's the impact overall? We pay a lower net price. Now, this is one of those where if I'm taking a futures market test, I usually get this sign wrong here and have to think about this a few times. But if we're thinking about buying an input, right, making money has the same effect on my bottom line as paying less for the input, right? And so basically, since we make 50 cents a bushel in our futures market, we subtract 50 cents from the cash price that we pay, and we land on this $4.75 net price. Now, you can go back and you can do all the different examples like we did before. You could have where prices go down, change the basis. All the math works out just the same for a long hedger. The point is, again, to be equal and offset in cash and futures. Okay, so that's short hedging and long hedging in a nutshell. And hopefully that gets the concept across. Now, a couple of sort of real world notes here. There is a pay to play feature for futures markets. So if you want to go out and you want to open up a futures market position, you need to work through a broker, an introducing broker, and you'll be charged a commission for each transaction. Well, we'll get to commission in a minute. Got ahead of myself. You need to, with that broker, maintain a margin account. So for every contract that you open, whether it's long or short, there is a established margin level. All right. And then if your equity, if your futures position is moving against you, you have to continue to replenish that margin account so that it stays up to that maintenance level. All right. Now, this can be substantial. And so again, in the current year, this is a big problem. You know, if grain producers had short hedges that were put on earlier on before this big rally, the margin requirements are substantial. All right. So this is something you got to plan for and plan ahead. They can be substantial, but that's there. All right. So that has to be maintained. Like I said, this requires substantial capital. I think financing margin requirements is probably one of the reasons, main reasons that hedging programs fail. Failure to plan ahead for this, failure to think about where's this capital going to come from. So just to give you a quick idea of the scale of this, corn contract right now, the margin for one corn contract is $1,425. So if we think USDA yield projections, I think somewhere around 167 bushels an acre. So you would need 10 contracts to cover 300 acres, to completely hedge 300 acres. That's a margin requirement of $14,250. Now, be really clear, this is money that you deposit. It's basically held in escrow. When you lift your hedge, you get this money back, right? It's kind of like collateral. It's saying, okay, I'm trading this big valuable contract. I will give this token of collateral in my broker account and keep it up to this maintenance level, right? But notice 300 acres of soybeans, about $11,000, 300 acres of wheat. Again, these are just kind of a little bit, kind of estimates, but a little bit over $5,000. Margins vary based on the value of the entire contract, right? So a soybean contract is for 5,000 bushel, but the per bushel price for soybeans is quite a bit higher than wheat, right? So that's why the margin for soybeans is higher. Just to throw up the livestock there, if you wanted to cover 150 head of live cattle, roughly you're going to need 5 contracts, $4,800 margin. That is wrong. That is $8,000. 5 times 1,600 is $8,000. Sorry about that. Feeder cattle, looks like I did my math right on that one. To cover about 195, 200 head, you're going to need $8,700. So again, this can really add up, substantial, and you have to plan ahead about where this money is going to come from and think about the opportunity cost of having it tied up in your broker account. You get it back when you lift your hedge, but having that out there is an opportunity cost, and it is a real cost to a business. The other real world note that we'll get into here is a broker fee. So introducing broker, basically, there's a sort of a chain of events here. An exchange like CME Group manages futures contracts. Certain people have a seat on the exchange, right? And they're the ones that can trade futures contracts. One step back from that is an introducing broker, which will introduce their orders to this person who's on the exchange. And then one step back from the broker are people like us who might want to trade futures, right? So the broker will offer you some level of service, and in exchange, you pay a fee. So you're going to pay per transaction. Every time you get in a position, and then when you offset the position, that's a transaction. And there's a wide range out there. So you can go sort of the electronic platform, point and click, you make the decisions, you sit in front of the screen, you do what you want, and those are quite cheap. I've got $5 there, but it wouldn't be hard to find less than $5 per transaction. The other end of the spectrum is the broker where, all right, you can call up your broker, get her on the phone, ask advice, specifically, what do I do today? Okay, it's Tuesday. What should we do Wednesday? That level of interaction, you're going to pay a lot more for, right? And so we're talking maybe $35, $40 up at the higher end of transactions, I think. The key here is, what do you need and what matches your personality? Do you want to spend time in front of the screen? Are you good at that? Do you want to do your own stuff or not? So figure this in. Again, it adds up. It can be a substantial expense. So to wrap up here and move into questions, a couple things. One more time, hedging is risk management. So if you're looking at, okay, I'd like to hedge so that my returns are going to be higher than my neighbor, then you're looking at the wrong tool. All right, that's not hedging. When you want to look back and you want to say, did I have a successful hedge or not? The comparison is, did you hit the target price? Okay, it's not, was my price higher or lower? It's, did you hit the target price? If you hit your target price, it was a successful hedge. That's the comparison to make. Now, losses in a hedging account will occur. And I've got here during price rallies, I had short hedging on my mind and I was thinking about the current grain markets. But if you're a long hedger, then losses are going to occur when prices are going down, right? But anyway, losses in a hedging account will occur. And so I put this out there for a couple of groups. First of all, if you're a hedger, this is going to happen, right? Because you're trying to basically get rid of price risk. And sometimes that risk is in your favor, all right? And in the cash market. And so in those cases, you lose money in the futures market. That's to be expected. If you're a lender and you see business plans, you see financial records, and you say, wow, these people, lost money here and there in their hedging account. That's to be expected, right? That doesn't necessarily mean anybody did anything wrong. It's to be expected. If you're looking, again, you're looking at somebody's financials, business plans, this is completely normal. There should be gains some periods. There should be losses some periods. That's the way it works. And then again, the financing, the margin requirements, think about that. Sometimes short-term debt is the most prudent way to do that. It might not be prudent, but in some cases it certainly is. So again, if you're a lender, it is not a crazy request for a producer or processor to look at short-term debt options to keep those margin accounts replenished, because it offsets that, it's a way to mitigate price risk. And hedging isn't the only risk management tool out there. Can throw that in as a concluding thought, but it is one. And so with that, I'll put these resources up. I can make this slide deck available. I know these links don't work very well on Zoom, but these are a couple places that I recommend. And so if there are questions, I saw some chat questions pop up. Jody, I don't know how you want to handle those, but I think we got a few minutes here. If there are questions, I'm happy to try to work with some of those.
Absolutely. So I believe our participants have access to unmute themselves and verbally ask a question. I know given the topic, there might be some more in-depth questions that are maybe hard to describe through typing them out. So participants, feel free to do that in respectful ways, of course. And then if you do have any other questions that are easy to type in, feel free to do that in the chat, and I will help Dr. Coffey watch that chat to get those questions answered. So yeah, with that, go ahead, fire away with questions. You got a few minutes here.
Hey, Dr. Coffey, I have a question. What books would you recommend to study this subject in further detail?
Did you say books?
Books, yes.
Yeah. I would say I would start online. I don't really have a specific book in mind, honestly. I put up some of these resources, and if you want to email me, I'm happy to give these to you. CME Group, and I have no affiliation with them. I don't gain anything if you go to CME Group's page, but they have excellent educational material, and they've got
Okay.
a lot of it is free, no pay. So that's great. And then you can also step up to their educational programs where you pay for that. But I encourage people to start there. Iowa State, historically, they've had good extension stuff, very well written. And the thing I like about theirs is it's real concise, like a livestock hedging document, a grain hedging document. So you can dig around there. And then our own Ag Manager page has some stuff up there too. So I would personally recommend starting there. Yeah, that'd be my suggestion. Does that help? So I've got a question. Let's see. I've got a question here from Nancy. How did this process get started? Do you mean futures markets? I'm guessing.
Yes.
Okay, yeah, so that's a great question, and it's interesting the way it's grown over the years. But it was basically this idea that, okay, if we could have this market out there as a way to offset the risk, and then probably the idea started a long time ago as sort of an insurance, and then it grew to commodities in the U.S., grew to livestock and different things. But that's the idea, is that there was people had something going on in the cash market that if they wanted to do it, put some stuff on a boat and take it across the ocean, very risky. So how do you do that? Well, get somebody who's willing to bet on the risk, right? So that you're not taking on all that risk. And then that grew and grew to kind of what we've got today. But fascinating history there, more than I can get into now. But that's a good question. Then we've got, is this something that the average rancher is doing? The answer there is that both in grains and livestock, producers and processors hedge less in the futures market than academics think they would. So we like to talk about hedging a lot. And then, I don't know, some research that I helped work on here a couple of years ago, and this is kind of limited, but grain, well, you said ranchers, but grain farmers in Illinois, Indiana, Iowa, Kansas, kind of that area. I think the survey there that Farm Credit Services did, I think we were looking at about 30% of grain farmers had used futures markets or options markets to hedge. So not the majority. What we've seen is over time it's growing. General, I think, conventional wisdom, and I don't have hard data for this, is that fewer livestock producers, as far as percentage of all producers, hedge than grain producers. So probably not the majority for sure, and probably not half. Is there a way to use this method to hedge against price fluctuations in products that are not listed in the futures market? I'm thinking pineapple juice concentrate. Is there a way to some sort of correlation between orange juice prices and pineapple? Oh yeah. So this is what we would call a cross hedge, and you're already on the right track there. Basically, what you need is a physical commodity whose price moves with a futures contract in a predictable way, right? And so that could be for any number of reasons. Now, it's quite obvious why that number 2 yellow corn would move with the number 2 yellow corn contract, right? But, something, for example, like wheat mids. Well, wheat mids might move with that corn contract because they're used as a feed ingredient, right? So I think what you're saying here, you're on the right track if whatever cash commodity you're using, for some reason tracks with the futures contract, then a cross hedge, that is where the cash commodity doesn't exactly match the specifications of the futures contract, is possible. Now it's a little bit more complicated. You don't want to hedge 1-to-1. So there's some complexities there, but it is something that people do, because obviously there's a limited scope of commodities out there on the futures market. So it's possible, takes a little bit more effort, and there's a little bit, the basis risk is probably, as a rule of thumb, greater than it is for the direct hedges, but definitely possible. Very good question. And then I think we're kind of winding down here, but my email, phone number's there. If you have a question, you want to email. Like I said, if these slides are helpful to anybody, I'm happy to share those. But yeah.
Excellent. Thank you so much, Dr. Coffey. I have a couple of things to finish us out here real quick. Okay. So first of all, thank you to everybody who joined in today. This session is being recorded, so we are able to share that recording at some point as well. So if we would love to connect with you through our social media channels after today. Our students and alumni are very active on our channels, so it's a great way to start meeting others who have done the MAB program. We would love to hear more about what drew your interest to the MAB program as well, if this is your first time joining us. And we'd love to talk through how we might be a great fit for you. You can visit our website at mab@ksu.edu and choose a time that works for you to talk with a couple of our staff members. If you know that we are the program for you, you can start an application. You can sign up for and complete an advising appointment, and we can send you a code to waive your application fee. So again, thank you for joining us. You can reach our MAB program at that email address on the screen and our website, as well as our phone number. So give us a call and reach out. Let us help you find and solve some of those problems that you might have. And in addition to that, feel free to reach out to Dr. Coffey with any follow-up questions. We can always share that slide deck with you as well. So thanks again for joining, and we'll see you at the next webinar.